One $500,000 check returned over $1 billion. Another one, a $12 million Series A, returned over $100 billion at exit. This is the story of the greatest venture capital investments of all time. What made them possible? What made them almost fail? And why they matter even more today. Venture capital is about betting on companies that no one believes in yet. And as you know, 90% of startup fails. But the best VC investments do more than just succeed. Instead of only returning a fund, they return hundreds of millions of dollars, sometimes billions. Let's dive together into the top 5 of the biggest returns of all time. Before we start, if you appreciate this content, please consider subscribing. I publish a new video every week on VC and the YC ecosystem. Thank you so much. Number 5, Sequoia and WhatsApp. In the summer of 2011, Sequoia Capital led an 8 million Series A for a small messaging app called WhatsApp. WhatsApp was founded in 2009 by 2 engineers from Yahoo who were kind of tired of the advertising first business model. They wanted to build something lean and quiet, a simple messaging app tied to your phone number with no feed, no gimmicks, just pure messages. They started with a small $250K seed round from their friends and ex-coworkers at Yahoo, people they'd been working with for years. And this money allowed them to grow quickly, silently in their own little corner of Silicon Valley without interference from big pharma. The product spread slowly at first, and then it started to take off and take off more and more and more. In countries where SMS were not working great, WhatsApp just worked instantly. It would get all of your contacts so you can talk to them immediately. It would use minimal data, and it would just allow you to send messages more reliably. By the time Sequoia came knocking on their door in 2011, they already had millions of users. But they're not raising money. Actually, the founder turned down every investor outbound coming to him. The founders didn't even want to pitch. They didn't want a board. They wanted independence. And more than anything, he didn't want anyone to tell him to add stickers to his product or to start advertising. He was against that. Jim Goetz from Sequoia understood this, and he did things differently. He was not pushy at all. He just started to build the relationship and try to be helpful and available. It took months for him to gain trust from the founders, but eventually they agreed to let Sequoia invest. Sequoia led the Series A, an 8 million round at a valuation under $100 million, and they did it entirely on WhatsApp's terms. Sequoia wouldn't take any board seats, they would not ask for any reporting, and they would not try to steer the company in any direction. WhatsApp kept growing, and they crossed 200 million users with less than 50 employees. That's quite insane. But their infrastructure costs were very tiny, and they were charging $1 per year and per user. That was their entire business model. Over the next 2 years, Sequoia invested another $50 million at a $1.5 billion valuation. The messaging was still lean, the app still clean, and the users kept on growing. Then came February 2014. Facebook acquired WhatsApp for $19 billion, the biggest acquisition for a VC-backed company at the time. Sequoia's investment of around $60 million turned into $3 billion in exit. That's more than 50x on some pretty big numbers, a rare feat in venture capital. John Coombe, the WhatsApp founder, signed the acquisition papers outside of a building in Mountain View, exactly where he and his family, when he was younger, were collecting food stamps just some years before. The picture of this is still out there, partly because it's poetic and partly because it reminds people that WhatsApp was built differently. And of course, Sequoia saw that. Number 4, Sequoia and Google. By the end of the 1990s, most people thought that the search engine race was over. Yahoo had taken the portal strategy. You had others like AltaVista and Lycos also with a lot of traffic. And so very few people thought there was space for another search engine as a white page and just a search bar in the middle. So when 2 Stanford PhD students came up with a faster, cleaner algorithm and a faster solution, most investors politely declined and passed. They thought search was already solved. But of course, Sequoia saw things differently. The introduction came through Andy Bechtolsheim. He founded Sun Microsystems, a legendary company here in the Valley, and he was reputed famous for moving very quickly when he saw something with value in his eyes. After seeing an early demo of the Google product, he didn't even ask for a full meeting with the founders. He took out his checkbook and wrote a $100,000 personal investment on the spot. That momentum carried over to institutional interests. Michael Moritz at Sequoia and John Doerr at Kleiner Perkins both saw the same thing. This wasn't just another search engine. It was outperforming everything else out there. And their algorithm PageRank did not rely on keyword stuffing. It was smarter than that. It treated the web as a system of authority tracking ranks in links. And it worked really well, and other people were really starting to notice. Engineers were switching to use it, and students on campuses were sharing the link around. Even so, Larry Page and Sergey Brin were not in a rush to take any outside capital. They had built Google from inside Stanford's Science and Computer Lab department, and they were not even sure if they wanted to make a real company out of it. And they already had turned down an acquisition offer from Excite. Sequoia and Kleiner Perkins finally convinced them to take outside capital. They split the round, investing both $2.5 million in the company. That single check gave Sequoia a $4 billion returns, a 300x in one of the most crowded consumer space. Sequoia backed Google not because they were excited about search in general, but because they realized if someone builds a product that's 10 times better, people will notice. Number 3, Benchmark and eBay. In 1997 in Silicon Valley, most people were chasing enterprise software or B2B infrastructure plays. The internet was still young, clunky, and slow, and honestly, to a lot of people, overhyped. So when a small team pitched a website to sell used goods, like your old sofa, most VCs laughed. But Benchmark didn't. They wrote a $6.7 million check to own 22% of a small website called eBay. 2 years later only, when eBay went public, that investment was worth more than $5 billion. That's a 750x in less than 24 months. Insane. And it all came from seeing something others didn't, like is often the case in venture. eBay wasn't even venture-backed at first. Pierre Omidyar had built the site over a weekend almost as a side project to begin with. His goal was to help his fiancée trade collectibles. It was crude, it was ugly, and there was no moderation at all. Actually, the first ever item sold on eBay was broken. And this moment is often quoted by the founder. That's when he realized that people would actually buy anything online. People kept showing up, they kept coming back, they kept buying and selling, and slowly they formed habits. Entire micro communities were shaping around weird categories like model trains or vintage baseball collectibles, whatever it was. In fact, in 1997, 10% of all eBay transactions involved Beanie Babies. And that's what Benchmark saw early, a new bottom-up economy. Bob Cagle, the partner at Benchmark who led the deal, had been tipped off by a Stanford professor. When he dug in, he noticed something unusual. Users were returning at a crazy rate. Sellers were becoming power sellers, and some of them were becoming small businesses thanks to eBay. eBay had no marketing channels and no budget, no cost of acquisition, just users that kept showing up again and again. At the time, most VCs were hunting for clean enterprise deals with polished decks. eBay was chaotic, it was none of that. But the behavior didn't lie. Benchmark backed the team at the Series A and immediately helped bring Meg Whitman as the new CEO. They placed real governance, professionalized the website, and helped it scale to mainstream. When eBay IPO'd in 1999, the rest of the market suddenly woke up. Suddenly, the flea market site looked like an empire, and Benchmark's $6.7 million investment turned into one of the biggest returns of the decade. What's easy to miss is how strange the bet looked at the time. One man auctioned on the website the naming rights to his unborn child. Someone sold a town in California. Another woman sold her wedding dress with a brutal, honest revenge story attached to it. Charities raised millions by auctioning celebrities' meet and greet. But Benchmark saw obsession and people blindly trusting and coming back to the platform. And that was new, that was unique. So where most investors saw low tech, Benchmark saw high fidelity and engagement. And that's the takeaway. The best early stage investments often start in a weird corner of the internet where people are doing some irrational stuff consistently. That's pretty much exactly the same story with Reddit that I covered in another video. If you're looking for the next big thing, don't just look at clean platforms. Look at obsession. Look at repeat customer interest and transactions. And look for the tiny economies hiding in the big behaviors. Number 2, Facebook and Peter Thiel. In the spring of 2004, Peter Thiel made an angel investment that would become the most iconic angel investment of his lifetime and one of the most iconic angels investments of all time. He wrote a $500,000 check to a company that at the time was just a website for college students. It was called The Facebook. It didn't have a business model, it barely had a team, but it had traction and Peter Thiel believed in the founder. And that one decision made him over $1 billion. Mark Zuckerberg was 19 years old at the time. He was still living in the Harvard dorm room, writing code late into the night every day, and slowly rolling out his website to other Ivy League's campuses. The product was raw, but it was already a success. The biggest problem they had at the time was the site kept crashing because of too much demand on the servers. But on the outside, it looked like just another social network, which at the time was very popular. Friendster was already fading, MySpace was full noise. Again, no one really believed there was space in the market for yet another social platform. But a few people close to the action saw something different. One of them was Sean Parker, the Napster co-founder, who had just joined Facebook as an advisor and who quickly introduced Zuckerberg to Reid Hoffman, founder of PayPal and then LinkedIn, and then introduced him to Peter Thiel. Thiel and Hoffman has known each other since Stanford and they co-founded PayPal together. They'd spent years arguing about different ideas, and recently they'd been talking a lot about social networks. Reid Hoffman had started his own social network in the 90s called SocialNet, and now he was working on LinkedIn, another social network. And both him and Peter Thiel had already invested in Friendster, though at the time it was already faltering. So of course, when they met Zuckerberg, they didn't need a long pitch. They immediately realized the potential. As Thiel later tells the story, we'd done our homework and we're gonna invest no matter what. Still, Peter Thiel moved with caution. His $500,000 investment came as a loan at first. If Facebook reached 1.5 million users by December 2004, then his loan would convert into equity with a 10% stake in the company. If not, he could just ask for his money back, a hedge for him with Facebook's messy legal situation with the Facebook co-founder Eduardo. That situation was still brewing at the time. Actually, Facebook missed the mark, but Peter Thiel saw enough at that point and he let the debt convert into equity anyway. And that single check would go out and make him over $1 billion in returns, making it one of the most legendary angel investments of all time. A month later, Zuckerberg came back with a new offer. It was his Series B at $75 million valuation. That was a long shot away from his first investment at $5 million valuation. Fund wanted Peter's new fund, Founders Fund, to lead it, but Thiel hesitated. The number felt high for a young company with graffiti on the wall. The team was still under 10 people, so to him, it still felt like a small startup. He passed. Of course, Thiel would course correct and actually invest in the Series C at more than $500 valuation, and of course, he still made a killing on that investment. But that moment of him underestimating the compound momentum shaped his investment decision in the future. So now he's famous for compounding and doubling, tripling in on his winners as much as he can. And number 1, Sequoia Capital and Apple. In 1978, a young venture capital firm called Sequoia Capital invested $150,000 into a scrappy little company called Apple. At the time, Steve Jobs was 22 years old and Apple was operating out of a garage. Their computers looked more like hobbyist kits than real products. When Jobs first approached Don Valentine, the Sequoia founder, he first turned him down. John was intense, the product was really rough, and Don wasn't really a computer guy. His thing was semiconductors. But Valentine did something smart. He referred Jobs to Mike Markula, a former Intel exec with deep business experience. Markula not only became Apple's first advisor, he became the bridge back to Sequoia. It was Markula's conviction that made Don Valentine take a second look, and then he invested. Sequoia's investment was part of a $600K seed round, but they quickly became the dominant voice on the board, and Valentine joined the board and stayed until the IPO. Apple seems obvious now, but at the time, the idea of personal computers seemed like a joke. IBM ruled the world, and no one thought people would actually need that machine in their homes. To most people, Apple looked like a toy, but to Valentine, it looked like the beginning of a revolution. Just 2 years later, Apple went public, a huge win, but the value kept compounding after that. And so that $150,000 investment kept through the IPO and slightly longer returned over $100 million. One investment, 100,000 return. If you want generational returns, you have to look at paradigm shifts before they become obvious. So yeah, that's 5 of the best venture bets ever made. They all look kind of different sectors, different stories, different founders. One interesting thing is that those companies were not really secret. They were on people's radars, and most of those rounds were not very competitive. But in every case, the investors that got in built a strong relationship with the founder and got the product very early, and they also did not overthink it. These were some of the strongest calls of the venture industry. And of course, they're easy to rationalize in hindsight. But at the time, you have to remember, they're just decisions made with imperfect information and some hunch. And that's still what it takes today. The next big company won't necessarily look obvious. But if you're paying attention to the trends, to the founders, to the behaviors, then you start to get a sense early of what's really big.